Commodity markets are shaped by sudden powerful shocks, wars, crises, and pandemics that disrupt supply and demand, trigger extreme volatility, and reshape global trade. Studying these events helps traders and policymakers understand risk and the forces that drive prices. 1. The 1970s oil crisis, OPEC, and energy dependence. Context. In 1973, the Yom Kippur War led OPEC to impose an oil embargo on the U.S. and allies for supporting Israel. Impact. Oil prices quadrupled from $3 to $12 per barrel, sparking global stagflation, fuel shortages, and long gas lines. Lesson: geopolitics can override fundamentals. The crisis exposed energy dependence risks and led to strategic petroleum reserves, fuel efficiency rules, and alternative energy initiatives. 2. Gold in the 2008 global financial crisis. Context. The collapse of Lehman Brothers triggered a global liquidity freeze. Impact. Gold first fell as investors sold assets for cash, then rallied from 2009 to 2011 amid fears of currency debasement from massive monetary stimulus. Lesson: during liquidity panics, even safe havens drop, but later recover as protection against inflation and policy risk. 3. Natural gas and the Russia-Ukraine conflict, 2022. Context. Europe relied on Russia for 40% of its gas through fixed pipelines like Nord Stream. Impact. Russia weaponized supply cuts, sending prices to record highs and forcing Europe into a costly shift toward LNG. Lesson: dependence on one supplier and rigid infrastructure created systemic vulnerability, driving a permanent energy realignment. 4. Agricultural commodities and the 2010 to 2011 food crisis. Context. Droughts in major grain exporters, low inventories, high oil prices, and rising biofuel demand strained supplies. Impact. Russia's grain export ban triggered panic buying, spiking wheat and corn prices, and fueling unrest across the Middle East and North Africa. Lesson: food shocks can destabilize economies and societies. Policy missteps like export bans can turn shortages into global crises. 5. Silver's 1980 price spike. Hunt brothers attempted corner. Context. The Hunt brothers tried to corner the silver market through massive leveraged futures positions. Impact. Silver soared to $50 per ounce before regulators raised margins, triggering a crash on Silver Thursday. Lesson: excessive leverage and speculation collapse when regulation tightens. Market manipulation always implodes. 6. COVID-19 and the oil price crash, 2020. Context. A Saudi-Russia price war coincided with global lockdowns that crushed demand. Impact. Oversupply filled storage tanks, forcing WTI prices below zero in April 2020. Lesson: when physical constraints meet futures obligations, prices can defy logic. Demand shocks can be more destructive than supply shocks. Summary: commodity shocks show how geopolitics, infrastructure limits, leverage, and demand collapse can overwhelm market theory, reminding us that real-world forces move prices faster than models ever predict.